In this video, we are going to understand the bonds because as a trader, especially as a gold trader, you should have a complete understanding of the bond market. Bond market, which is also known as securities or debt market, is a financial market in which two business entities conduct business with each other, an investor and the issuer. An issuer is an entity which needs funds for some project or for some short or long term business capital. In return for raising the capital from the investors, it pays an annual or semi annual interest to them. The bond market is the largest financial market in the world. For comparison, the foreign exchange market, which we normally call the forex market, has approximately $9 trillion of volume turnover in a single day. But on the other hand, the bond market is approximately 16 times larger than it and has a volume of around $146 trillion. In terms of categories, the bond market is divided into two categories, the primary market and the secondary market. The primary market is a market in which the issuer first issues the bonds. The investors, or you can say buyers, in this primary market are not normal retail investors. These are mostly government bodies, government owned companies, or institutional investors. After buying the bonds from the primary market, these are then traded in the secondary market. The three key elements of a bond are par value, which we can also call the principal amount, coupon rate, and maturity date. Par value or the principal amount is the amount which the issuer raises at the initial starting of the bond. The issuer must pay the par value on the maturity date. Coupon rate is the rate of interest which the issuer have to pay to the investors. It can pay it to the investors annually or semi-annually. For example, a bond has a coupon rate of 12% semi-annually. It means the bond issuer will pay the investor 6% after the 6 months and 6% after the 6 months. But some bonds like zero coupon bonds have no coupon rate. Instead, they are sold to the investors at the discount to the par value. For example, there is a zero coupon bond which has a par value of $1,000. It means the investors will get $1,000 on the maturity. But when it is sold to the investors, it is sold on the price of $900. It means if the investors will hold it to the maturity, they will get $1,000. They paid 900 but will get $1,000. The difference of $100 is the profit of the investor. There is also another type of bond such as FRN, which is floating rate notes. The coupon rate on these bonds are not fixed. Instead, they change constantly till the maturity of the bond. These rates are based on the reference rate plus spread. If we talk about the maturity is simply the date on which the issuer returns the par value to the investors. The maturity date of a bond may vary from 1 day to 1 year to 10 year to 100 year or to eternity. For example, in the United States, the bonds which have a maturity date from 1 day to 1 year are normally known as T-bills or money market security. The bonds which have maturity date ranging from 5 year to 10 year are known as T-notes, and the bonds which have maturity date ranging from 10 year to 30 year or above are known as T-bonds. There are also bonds which have no maturity date. Such bonds are called pure perpetual bonds. Now, if we talk about the types of bonds, there are various types of bonds, but the main four types of bonds are plain vanilla bonds, zero coupon bonds, inflation linked bonds, and floating rate notes. For example, if we look at the plain vanilla bond, it is the simplest form of bond. The issuer issues a bond in which it wants to raise a particular amount of capital from the investors. It will pay them a predetermined fixed rate of interest either annually or semi-annually, and the investors will get their principal amount on the date of maturity. Second is a zero coupon bond. A zero coupon bond does not pay any kind of coupon. Instead, as we discussed earlier, it is sold at the discount to the par value. For example, if it is sold on $900 and if the investor will hold it to the maturity, they will get $1,000. The difference of $100 is the profit of the investor. Third is inflation linked bonds. These are bonds whose coupon rate is directly linked to the real inflation rate. These are mainly made to protect the capital of the investors from the inflation. Fourth is FRN, floating rate notes. These are the types of bonds whose coupon rate changes constantly from the date of issue to the maturity date. The coupon rate is made up of two elements. First one is reference rate and second one is spread. The reference rate changes constantly throughout the maturity date of the bond depending on the market rate, and the spread is directly dependent on the credit quality of the issuer. Now, who issue these bonds? The bonds are issued by national governments, local government or municipalities, or corporate bodies. Among all these issuers, the government bond is the safest kind of bond because, for example, if the government raises capital from the investors for a particular type of project, but the project did not succeed and government doesn't get enough cash flow to pay the investors back, in that situation, the government can simply print the money, inject it into the economy, do some open market operations and pay back to the investors, or it can simply raise taxes to pay back the investors. That is why the government bonds are the safest as compared to other bonds. Corporate bonds are issued by corporate or private companies for some project or for some long or short term capital. The quality of the corporate bond is directly linked to the creditworthiness of the company. That is why the companies which have high creditworthiness usually have low yield, and the companies which have low creditworthiness usually have high yield. Now, if we look at the bonds on the type of issuer, the first type is sovereign bonds. The sovereign bonds are bonds which are directly issued by the central government. Second is non-sovereign bonds. These are bonds which are issued by local government or municipalities. Third is corporate bonds. These bonds are issued by corporate or private companies. And the fourth one is foreign bonds. It's a type of bonds in which the issuer has been incorporated into some other foreign country. Now, if we look at the relationship of bond with the other financial market such as stock market, gold, we can see that the direction of the bonds and stock market are same, because when the economy of a country is doing pretty well, the interest rates are rising. On that particular case, the bond yields are more attractive to the investors as compared to the non-yield providing assets such as gold, because both are safe assets, but the interest rate on the bond is much higher as compared to the non-yield providing assets such as gold. In that case, the investor tried to pull their money from the gold and put it into bonds. The price of the bonds rise due to the demand, and the price of the gold decline due to the excess of supply. But in case of geopolitical tensions, wars or pandemics, the price direction of both the bond and the gold are same, because both are safe assets and investors try to preserve their capital in these both safe haven assets. Now, if we look at the retail participation in the bond market, the retail participation in the bond market is generally low because of restricted entry, high capital requirement. But in the recent years, the rise of the bond ETFs has made the retail participation possible in the bond market even with the very fractional amount of dollars. So, in this video, we tried to understand the basics of the bond market, because as a trader, we should have a clear understanding of the bond market, because the bond market directly influences the interest rates, the stock market, the currency market, and the commodity market, especially gold. I hope you liked this video. If you like it, do let me know in the comments. I will see you in the next video. Till then, bye bye.